The possibility of the rand depreciating substantially has been on the minds of investment managers for some time now. This, combined with JSE that looks fully priced, has led many local managers to look for greener pastures offshore. One of those has been Roger Williams. He's from Centaur Asset Management, and he joins us in studio now to discuss his offshore stock picks with us. Welcome. So what are your interesting picks? Because of course, Roger, there's a huge universe out there from which to choose. Where does one start? Do you start with a filter and then from there, or is it literally a bottom-up process?
No, I look more for top-down thematic trends. So one of my most successful has actually been a Singaporean listed property stock. You could have bought it a year ago on a forward yield of about 8.5%, which is exceptional for developed markets. And Singapore also is a very stable country with a strong current account, and their currency is going to be very strong. So you basically got everything. You've got a high yield, a good country, and a rising currency, and that's up about 40% in the last 12 months.
Roger, why so cheap then? I mean, that's a well-developed market. Singapore's a great place to invest. I hear such good things about the business environment there. We've seen South Africans going over there and living over there. Why did you find this discount?
It was a recently listed company, and it was trading a bit of a discount to the other Singaporean stocks. But also what happened in 2011, you remember the whole debt crisis, and what happened is a lot of yields actually spiked up, and Singaporean property yields also spiked up. So it was an opportunity to get in at a slight discount.
Was it just the one company that you found, or was it almost a sectoral trend, as you pointed to, where you found a couple of companies there and you just elected to go with this one?
Yes, I really got a pointer from someone who lives overseas and really did the in-depth analysis and pointed it out, and then I followed that. So he really identified it as a great opportunity, which it was.
Now, you're quite happy to invest. I mean, I don't expect fund managers to go to every geography that they invest in, but I mean, are you comfortable investing in places like Singapore where you may or may not have gone to before?
I think if you look really from a macro point of view, you have to identify which countries are good and which aren't, and the more you get overseas, you actually see it's quite a minefield out there. People talk about India or Brazil as good investment destinations, but often the governments change the rules of the game, ad hoc, and that's really a very big risk. For example, I was looking at Banco do Brazil, and the government, which is a major shareholder, really said they had to start extending loans, which is very, very bad, having the government pressure. So there are a lot of intricacies investing on a global basis, and you really have to do your top-down country research. And there's certain countries which are better than others. For example, France just raised their tax rate in 2011 from 30 to 36%. That's very negative. Whereas Germany is a far more stable environment, their tax rate didn't change. So one has to really look at a track record of a country and not only look at values. I think that's a very important criteria.
Roger, one of your other picks is Vodafone. So I know very little, aside from the fact that it's a cell phone company, but I would imagine that this gives you this global reach, and in particular also an exposure to emerging markets, which is what everyone's looking for.
Yeah, it's primarily a developed market country. The kind of jewel in the crown is they own 45% of Verizon Wireless in US. That's basically over half their profits. And that business is really a world leader in mobile telecommunications. And if you look what's happening there, they just grew their revenue quarter on quarter 9%. So the data is really starting to manifest and grow the company. And I see Europe and emerging markets behind that, but over the next 10 years it's going to be a massive theme, really mobile data, and I'm really buying into that, and it's relatively cheap at the moment.
So I mean, this is, and we can look at this with some local context here, obviously with MTN and Vodacom listed. What you're talking about is a global trend towards using your mobile devices more for data than for calling in the case of phones, and like I've got on the table here, an iPad in the case of just downloading, surfing the internet and using it for work. So in terms of this translating forward, I mean, besides the likes of Vodafone, do you expect that data carriers like MTN and Vodacom will benefit from this in Africa in a relatively short space of time, or do you think we kind of lag by a couple of years, these
yeah,
trends?
I think we do lag by a couple years. Often the 3G networks aren't up to standard, and the smartphone penetration is quite way behind, and then also the applications. So the adoption cycle is later. But one also has to be cautious because there is cannibalization of the voice services. So it's not all growth. There's a lot of loss and gains, so you have to look at the net gain. So in developed markets, it kind of offsets each other to some extent. So the growth isn't exceptionally high. I'm not looking for 10% plus growth, maybe 4 or 5% growth, essentially.
And that Vodafone, besides obviously having the exposure to the North American markets, is also a fantastic play on the emerging markets. So would you say it's the sort of leader in global telecoms from a mobile perspective worldwide?
Yes, I would. It's not the largest. I think China Mobile is bigger than them. But it's the most widely spread on a global basis, over 400 million subscribers. But having said that, emerging markets are only about 10 to 12% of revenue. They're the second biggest in India, but it's not a very big profit source as yet.
Roger, we've got to wrap it there, but maybe in 30 seconds, just your final message on finding a Rand hedge stock and the importance of that for a retail portfolio.
I think the easiest Rand hedge and probably the most solid is really British American Tobacco. It's a defensive stock. It's a pure Rand hedge. So if you're not going to go offshore asset swaps, that's the easiest to get exposure. And it's been a great investment over long periods.
Roger, thank you. Roger Williams is from Centaur Asset Management.